Am I too old to invest is a question that a lot of people ask me all the time. My answer will always be no, you're never too old. Just get started already. However, that's just my opinion and there's a lot more detail to cover. So that's why I thought I'd ask the same question to some of the leading financial advisors here on YouTube. I not only asked them if you can be too old to invest, but more importantly, I got their top tips for anyone wanting to get started investing a bit later on in life.
Look, you are never too old to invest. I know some people think, well, I'm already like 40 or 50. What's the point of starting saving for my retirement now? It's kind of too late. I've missed the boat. That is absolutely not the case. You can make a massive difference to your financial future, even starting in your 50s. I mean, anything you can put away has got to be better than nothing, right? So you're never too old to invest, you're never too old to start.
The short answer is no. And I think the reason for that is we're all trying to outrun the same thing. The reason that we invest is to outrun inflation. And that problem exists whether you're 25, 35, 55, 65.
One of the biggest mistakes I see from conversations with clients is thinking you should base your investment strategy on your age. Instead, you should consider investing based on the age of your goals.
Okay, so clearly everyone thinks that you're never too old to invest. In fact, if you have a look at the latest data from HMRC, you can see that at pretty much every age category, there are people using their individual savings accounts to either save or invest their money. There's a fairly level spread between the ages of 25 to 65 plus, but obviously you'll notice that the older the person is, the more likely they are to have a much bigger ISA pot. This is the black line here running upwards. There's no surprise when you consider that someone older has had more time to save, more time to invest, and more time to enjoy the long-term returns of the stock market or their savings account. However, don't be put off by this if you think you'll never be able to build anything close to this amount. You've got some tricks up your sleeves that the guys will touch on a little bit later. Now, in the same HMRC data, we can see that most people, regardless of their age, aren't investing at all. In fact, most people are using the cash ISA account, and it makes up more than 60% out of all the types of ISA that people are using. If we look at this dark blue line here, it's the amount of stocks and shares accounts that are actually being used, and it's less than 4 million in total. So in a country of more than 40 million adults, we know that way less than 10% of people are even using an investing account outside of their pension. So no matter what age you are, if you start investing, you're already way ahead of most people. But why start in the first place? And what should we be thinking about if we're starting a bit older?
The whole purpose of investing is just that you can beat inflation so that you can have more money later. And inflation is the worst over longer time horizons. You don't really notice it over a year or two. Likewise, volatility, the ups and downs along the way, as long as it's a well-diversified investment portfolio, and I mean typically in equities, the great companies of the world, history shows us that smooths out over time.
You're never too old to invest, and we all have that same challenge, which is to try and overcome. We need our assets to keep going for the long term and hold their value.
And just going on from that then, if someone's going to come to you and they class themselves as older, what would be your best advice to these people, kind of your top tips to get them through?
Yeah, so, I do tend to deal with a lot of people in this sort of later life category. And I think one thing that I notice, and it's individual to each person, but one thing that might change as you get older is really what your objectives are and your appetite for risk. So lots of people, their focus tends to shift away from growing their assets more to protecting and preserving what they've got. You spend a lifetime building up this pot, your focus tends to shift more to keeping hold of what you've got. So although you're not too old to invest at this stage, it might just call for a slightly different approach.
Remember that the primary growth engine for building wealth is equities, that is, shares in the great companies of the world. So you want to invest primarily in shares. You want the proportion of your portfolio, if not all of it, to be in global equities. We can water it down a little bit. Very often we will dilute the equities with bonds, but just because you're older doesn't mean you need to take the foot off the gas and be sort of more cautious with your investing.
So that's interesting, isn't it? Basically, everyone agrees here that you want to invest because you need to beat inflation, and you also want to use a well-diversified portfolio. But let me just break that down for a second, as this can get very complicated if you're new. The first part is easy. Inflation is the enemy that we all need to beat. Very simply, if you do nothing with your money, it will lose purchasing power over the years. If you keep all of your money and leave it in your bank account or under the mattress and you get no kind of interest at all, you are guaranteed to lose money. For example, if you go to the Bank of England's website and use their inflation calculator, you can see that £10 from 2005, just 20 years ago, is worth the same today as £17.63. Now, in simple terms, all this means is that you need £17.63 to buy the exact same things compared to 20 years ago with that tenner. Inflation has reduced the value of your money by more than 70% over that time period. And like Tom and George mentioned earlier, inflation is our enemy no matter what age we are. On the second point about investing, here's where things can get very complicated as there are millions of different options to choose from.
The word investing can cover a lot of ground in some sense. It can mean a lot of things to different people. Some people consider investing as putting their money in their friend's business, cryptocurrency, or a new tech startup. That's not the same as a well-diversified investment.
So what does that mean exactly? Well, when they talk about a well-diversified portfolio, everyone's generally speaking about investing in lots of different kinds of things. The best comparison is using a phrase that you don't want to keep all of your eggs in the same basket. And this applies no matter what age you are. If you invest in only a single company, for example, and that company were to go bust, you could lose all of your money. However, if you invest in 100 different companies from lots of different industries, you've got a much better chance of success. Now, you can easily do this today using a good investing app or platform, and we've also got access to these amazing things called index funds, which basically allow us to invest in hundreds or even thousands of companies from a single investment. Now, I've done lots of videos comparing these platforms, and I also leave links in the description to the ones that I use, so I'll leave you to research those after this video. But very briefly, a very popular index that I'm sure you would have heard of is the S&P 500. This is an index of some of the largest and greatest companies that are based in the US. Companies like Microsoft, Apple, Meta, and Alphabet are all on there. Index funds allow us to invest in all of these companies together, and as they grow over time, we get the benefits that come along with this. Even if a few of these companies were to fail, the index adds in new companies all the time to replace those ones. It doesn't mean that we can't lose money, but it does mean that we remove the risk of just having a single company to invest in. Now, if you look at the long-term chart of something like the S&P 500, you'll see an incredible rise in value. However, that doesn't mean that it's guaranteed to go up in a straight line. There have been many years when the returns are negative, and this is where investing gets really tricky. The reality is that most people don't stick with it for the long term, regardless of their age. And when times get tough, they make really bad decisions. In fact, all of the data shows us that most people fail to beat the returns of an index fund like this, as they make lots of very, very bad decisions.
I mean, you and I have discussed this before, but I'm a big believer in global equities. If performance was the only thing we had to contend with, we would just fill a portfolio full of 100% global equities, and why on earth does anybody entertain anything different? This chart behind me and other things, we all know what the data says, but when we're dealing with people, not robots. So the best portfolio is the one you can stay in your seat for. So if you are later in life and investing and your objectives are slightly different, it might call for a slightly different approach.
I guess it's similar like in a diet in a way. If there is one diet we could all follow technically, and it would meet our calorie needs and we'd all be perfectly happy and live happily ever after, but we know we can't all stick with it. So in a way, it's very similar to that, accepting that we're all different really, and we need to find something that matches like our own goals, I guess.
Yeah, definitely. I mean, I always use that phrase, the best portfolio is the one you can stay in your seat for. You don't want sleepless nights and be sat worrying about how your investments are performing.
So your calendar age, as in how old you are, isn't the biggest determinant. You can have someone who's 30 who shouldn't be investing if they're going to buy a house at 31. Likewise, you can have a 90-year-old who's investing for legacy for their grandkids, and they know they are not going to touch that money for 10 years, and it could be perfectly suitable for them to remain completely in equities. It's not about your age, it's about the time horizon of your goal. There is a caveat here though, and I'm assuming that you're investing in what I consider the right way, and I think being older does create a reason to be more cautious with what investments you choose. Not necessarily whether we invest full stop.
So if you can stay in your seat for the long run, I always like looking at this bit of data that shows us that the longer we remain invested, the more chances we have ensuring that we don't lose money. You see, no matter what age you start investing, you're all probably going to have to put up with both the highs and the lows over the long run. And even starting in your 50s or 60s, you're still very likely going to need to be invested for multiple decades. In this research from the Investment Association, they asked people what the reason was for them to invest, and they separated the answers by the age of the people responding. What is interesting here is that other than the age range of 18 to 34 who said that the main reason for their investing was to get a property, everyone else in the older category said that they wanted to save for their retirement. More than 50% of those who responded said that this was their main goal. And if this is yours too, you're more than likely going to still need to be investing for decades, even if you start a bit later on in life. Now, it's much easier to start investing at a young age, put loads more money in, and let compounding do its thing. So what tricks and tips are left that older people can use and that they should focus on?
If you're starting in your 50s or even in your 60s, you're going to be investing for decades still. So you should push that money hard and make it grow by investing primarily in equities. It's true for everybody, but particularly if you're starting late, you want to prioritize paying and saving and investing into pensions, simply because of the tax relief that you get for doing so. It's money that instead of paying tax to the revenue, it goes into your pension. And if you're employed, you get your employer's contribution as well. So you can literally double your money overnight, and there's nowhere else you can do that. So prioritize pensions. Keep costs to an absolute minimum. There's a whole lot of things you can't control in the world, but one of the things you can control is the costs of your investing. So look for low-cost platforms and index tracker funds. They are super low costs and they'll do the job perfectly well for you.
So that's a good reminder that when investing, we should try and focus on using the right types of accounts. Pete reminds us that our pensions, not to be confused with a state pension, can be one of our best tools as we can get tax relief when we put money in. Also, if you are employed, then you'll be getting money every time you get paid from your employer. And this goes straight into your pension. Now, almost everyone watching this video will be paying into a pension somewhere, and you've probably even got some pension pots lying around before if you've had other jobs too. I personally made sure that I got all of my pension pots together and transferred them into a SIP, which is an account that lets you manage this money yourself. I actually share all of my investments here on YouTube, so if you are interested in that, you can watch those portfolio updates after this video. Now, just quickly, other than the pension account, don't forget about the Stocks and Shares ISA. This is a tax-free investing account that lets you put in up to £20,000 per tax year. Now, every UK adult gets access to this, and there are no age limits at all. There are now quite a few people out there who are ISA millionaires, as they've used up all of their allowances over the years, even before they were called ISAs, and they made some pretty savvy investments too. They can take all of those gains completely tax-free, and they can even donate it to whoever they want. If you are 70 years old and have some cash that you want to protect from any future taxes, you can put money into an ISA account, which includes the Stocks and Shares ISA. I've done a video on this which you can watch after, going through the details, but no matter what age you are, it's really important to use the right accounts, as this can really help reduce the amount of tax you have to pay, letting you keep more of your money invested. Let me just show you something really quickly, which, to be honest, applies no matter when you start investing. Now, I've said that a lot in this video, which hopefully you can see is a bit of a clue. If you can avoid fees, taxes, or any other costs, you can end up with a lot more than someone else who uses the wrong account. Let's say you invest £300 a month across everything, including your pensions and ISAs. If you can do this for 30 years in a row and you get an average return of 6% a year after inflation, you could end up with just over £295,000. That is an awesome pot of cash. Now, just imagine you used the wrong accounts, you paid higher fees, and even had some taxes to pay too. Let's say that this costs about 1.5% per year. It might not sound like much, but here's what this does over 30 years in the same example. Instead of having £295,000, you now end up with £226,000. That's almost £70,000 less, or 30% less in percentage terms, just because you had those extra fees and taxes. Anyway, what about some final tips and tricks?
Top tip is not to check the value of your portfolio too often. It's very tempting to sort of keep an almost religious eye on it, check it every tea time or whatever. There's just no need to do that, and actually it'll probably hurt you because you'll see the daily fluctuations much more closely if you do that. I suggest you don't check the value of your portfolio any more than once every 3 months, and if you can stomach it, don't check it any more than once a year. When you're starting late, it's sort of tempting to want to kind of get a jump on your investing, to try and push it harder because you're starting late. And there's always tempting, shiny things coming along that might sort of promise a higher than average return. And you think, well, that's the answer to my prayers, really. That's how I get back to where I would have been had I started earlier. You should avoid those things like the plague. They're usually super high risk. Very often there's no sort of investor protection in them. Very often, things like crypto or startup investments or whatever, they can be very illiquid. It's difficult to get your money out. So stick with the basics and just go fast and hard. Save as much as you can and invest primarily into global equities.
As people get older, they should be asking the question, what risks am I comfortable taking? But another thing I hear from clients about their pension pot is, should I just reduce my risk level because I'm about to draw down on my pot? And the mistake here is thinking that your pension is just one singular thing. In reality, for most people, your pension is going to be invested for 30, 40 years. But you're going to spend different chunks of it at different times. So yes, age is something to consider when thinking about taking investment risk, but it isn't the sole thing that should determine whether you do invest.
So are you too old to invest? We don't think so. Now, what are you waiting for? I've done loads of videos to help you get started, including a complete beginner's guide here and this handy explainer on stocks and shares ISAs. I'll see you in the next video. Happy investing.